Thanks everyone for joining today's webinar. The slide deck can be found in the handout section of your webinar toolbar. Please use the question section on the right-hand side to ask questions throughout the presentation. We'll be holding questions till the polling questions. We understand that we may not be able to cover all of your questions during the Q&A section, so we appreciate your patience. We will also be sharing the slides and presentation video recording link following the live presentation.
Okay, I think we're give it another minute. I still see a fair amount of people trickling in, so give everybody a minute to get situated here virtually. And then Izzy and I are going to share a lot of relevant information about something that all of us don't understand, including myself. All right, we'll get going. I see the number kind of slowing down here. So good afternoon, everybody, or good morning if you're on the West Coast or another non-Eastern Standard Time jurisdiction. Today, Izzy and I are going to be covering the cryptocurrency considerations for not-for-profits. So a very relevant topic, something that we've been actively invested in over the past, I want to say more than a year now, just seeing this hit our industry in the not-for-profit world very, very closely. We're on the tip of the iceberg of it in our estimation, and many of you, if you have not experienced or answered a question or had a question on it, I guarantee you will in the near future. Either a donor is going to approach you, your auditors are going to approach you, you're going to receive, your fundraising department's going to receive assets and say, how do we account for this? And you're going to be like, oh no. So today we're just going to cover a little bit of the basics, give you a little of the industry trends, and then certainly if there's any questions, we'll do our best to answer them at the polling questions. Or afterwards, we're more than happy to answer any emails or phone calls if anyone has any further detailed scenarios. So I am Brad Caruso. Many of you may know me. I'm the practice leader here of the not-for-profit niche at Witham. I've been here for my whole career, 15 plus years. 15 years and 10 days is the plus. And I host our Civic Warriors podcast if you want a good podcast or want to hear a couple insights into the crypto world. We've done 3 different cryptocurrency podcasts to listen to. I volunteer in my fire department as my civic duty, and you can see my 2 kids on there who are having fun at the beach recently.
And hi, everyone. I'm Izzy Tannenbaum. I'm a partner in our National Tax Service Group, really focused on not-for-profit organizations, as well as some employee benefits tax work. Really been in the industry practicing for just about a little over 20 years now. I've been with the firm here about 2 years. Before that, spent about 10 years at Big Four and other mid-sized firms, really always focused in not-for-profit tax and working with not-for-profit organizations. I do own several properties in the metaverse, and definitely am very excited about crypto and blockchain technologies and how they're going to be affecting our daily lives, as well as our industry. So really excited for this webinar and to get into it and talk about it.
Good deal. And I had no idea what the metaverse was until Izzy explained it to me. So, a couple things is what is a crypto asset and what should you know? So Izzy's going to talk a little bit about what that metaverse actually means. We're going to talk about some of the tax issues that we see popping up every day. We're going to talk about the auditing and accounting issues. If you're holding these types of assets, or if you're considering holding these type of assets, what should you be thinking about for how it's going to affect your financial statements, as well as some compliance considerations. And then lastly, we kind of put some things that we've been commonly recommending, as well as some discussion points to bring back to your board, bring back to your organization, or if you're an auditor or tax accountant, just to have ready as you're auditing or talking with companies. We are talking about this from the not-for-profit perspective, so we are thinking in the lens of if you are a not-for-profit, but certainly some of these principles can be translatable to other functional areas. And just as a volunteer firefighter, I take every opportunity I can to share some wisdom. And every presentation I do starts off with a fire safety tip. So some of you celebrated the 4th of July. Some of you celebrate the 4th of July for 365 days of the year and buy illegal fireworks. So the one thing that I learned in my day, and this actually happened to a close family member of mine, they took fireworks that were burnt out. So they were completely used up. They had their fun fireworks show and they threw them into the garbage can. So the one thing that you want to not do is throw hot fireworks that are used up into the garbage can, because they will catch fire, they will melt your garbage can, and they will potentially light your house on fire. So, very, very simply, and this same principle applies to hot ash in your fire pit outside if you have a fire pit, in your fireplace inside if you have a fireplace, or if you're a degenerate and like to burn leaves in your driveway. Just know that before you put them into your garbage can, you should water them down. You should not put hot materials into a plastic garbage can. If you have a metal garbage can, it's a little bit better because the metal is not going to light on fire. But just know that you should not do that. And you should do your best to take precautions, i.e. use your hose, water it down before you do anything, dispose of them. I usually leave the remnants in my fire pit. I don't like to dispose of them until much later, so as to not create that problem. Had some very, very funny stories, which I'm not allowed to tell here, but some people do silly things in the world. So with that, let's go into polling question number 1 so we can get everybody some CPE credit.
All right, polling question number 1. What are the potential uses of digital assets for not-for-profits in the future? Membership, smart contracts for payouts, transferring funds to hard-to-reach places. A through C are all logical, no uses at all.
Let's see if everybody says there are no practical uses whatsoever, and we can tell you about the relevancy of this presentation.
All right, we're about 70% voted, so I'll give it about 10 more seconds. All right, get those last minute answers in. Right. So it looks like we have 3% said membership, 11% said smart contracts for payouts, 3% transferring funds to hard to reach places, 80% A through C are all logical, and 4% said no uses at all.
All right, so I think all those answers are true. I think some of those have limited utility, or some individuals, parties will use digital assets in different ways. Some will take advantage of all ways. Izzy's going to talk about NFTs and that membership concept, which is going to be a big thing that we're starting to see trend. And many of you, to be quite honest, may say there's no utility at all, and this is just a trend that we don't want to partake in. And for those of you that bought digital assets in December, your cryptocurrencies, and then are looking at it now, you're like, why did I buy this? I'm one of those individuals. So let's talk about it. What is a digital asset? What is a crypto asset? And what should you know? So, Izzy did justice here and pulled out some of the main headlines of how digital assets and cryptos are affecting not-for-profits. Some of the headlines you see in here: crypto donations to charity are booming. What do you need to know? Charities accept more Bitcoin donations as a rise in the cryptocurrency. Wealth fuels giving. You see a lot of these, and a lot of organizations took advantage of this. We did a couple of podcasts with a couple of payment processing entities. The Giving Block is one of them, and Given is another one. And one of the things they mentioned on the podcast is just how much individuals wanted to donate their digital assets. There are a whole host of types of digital assets, which Izzy and I are going to cover, kind of giving you the broad breadth. Many of you know what Bitcoin is. Many of you know what Ethereum is, but you may not know what an NFT is. And they all have similarities in the fact that they're part of this Web3 structure. But to be honest, many nonprofits partook in this. Many nonprofits benefited from this, from these types of assets. And really, we've noticed that there's a significant trend in giving. There's a new age of donors that are giving in different ways. And in order to access those donations, many charitable organizations have had to immerse themselves in this world. It's not enough to just have a donor call you and say, I want to donate Bitcoin, and you accept it. There's a lot more to it. And so we're going to cover a little bit about that today. When I think of this, and when I was preparing for this presentation, I was trying to just define it a little bit. I've used some definitions that I've seen out there publicly. The AICPA has a good guide on this that they put a lot of time and effort into. You can tell, and you can access it if you're a member. But really, when you think about digital assets functioning as a medium of exchange, what are they not, right? So Bitcoin, if you use Bitcoin as an example, Well, Bitcoin is not governed by anybody. It's not issued by a governmental authority. It's not a contract between an asset holder and another entity. There's no contract you sign. You're transferring some form of value back and forth. It is somewhat of a store of value. It's not a security under the Securities and Exchange Act of 1934. So if you think of these things, these are the different areas that classically define a financial asset, right? If you think about a financial asset like cash, investments, they usually fall into one of these three buckets, to define what it is. With a crypto asset, there's no party that needs to approve a transaction. There's no central bank. It's one of the reasons why it's extraordinarily popular, is that a digital asset is not regulated by anybody, is that there is a free flow, is that a transaction can go from here to Africa in a matter of seconds, and there's no authority taking fees per se. This concept of cryptography, digital assets use cryptography. That's one of the mechanisms behind the scenes. And often these types of assets operate on a blockchain. So many of you years ago heard about, what is blockchain? How does it affect us? And many people didn't know. Well, now all of a sudden it's the main technology behind how these assets function and operate. So we're definitely seeing the blockchain come into the mainstream, for which my expert over here is going to talk a little bit about the blockchain because it's relevant to the concept here.
Absolutely. So, we've been talking a lot about and seeing a lot of the headlines. So I think it's clear that this is going to be something that's impactful and going to be something that's going to be prominent in our lives going forward. So we felt it was a good idea to kind of take a step back and make sure we understand a little bit about what these are, again, to the best of our abilities, because there's, what these are. And I think this kind of goes back to that first polling question a little bit. Maybe there should have been a choice that's TBD, because in some ways, these technologies are probably going to be adapted to have major impacts in our lives that we can't even foresee yet, since I think we're in the really, really early stages of this. But starting at what is essentially the core of all this, and where all these different types of cryptocurrencies, NFTs come from, is blockchain and the blockchain technology, which was essentially created, as most people know, by someone with a pseudonym, so no one really knows who he is, Satoshi Nakamoto. And so essentially he wrote this paper describing blockchain technology, and the first adaptation of that was Bitcoin, which is used as a cryptocurrency. But blockchain is the technology that actually powers Bitcoin, really any other cryptocurrency, and really all Web3 technologies. And just to take a step back and kind of define that, because I know Web3 is a term that we use a lot and is thrown around a lot. Web3 essentially is the all-inclusive term for all types of blockchain technologies that we're seeing now. So Web 1, my understanding is that Web 1 was really the original internet when it came out. So you could post up websites, people could look at that and read that, but there really wasn't much more interaction beyond that. Web 2 really was where you started getting an interactive web. So social media, big tech companies coming in and kind of centralizing that. And Web3 is really blockchain technology, the major difference being where it is trying to decentralize and get away from having those sort of big tech companies, or even in the cases of currency, big governments involved in these different transactions. So blockchain itself controls information through secure, auditable, and immutable records. The great thing about this being that it's transparent and permanent. So everyone's on the same page about the transaction that happened, who did what, and you can really see that transaction and trace it. And that provides a lot of transparency among all the different parties in a transaction. As we said, it's decentralized. It's a digital distributed ledger of transactions that are recorded in real time across a network. So again, everyone's able to access this. You can look at the blockchain and you can see the actual transaction and the parties involved, or I should say the wallets involved, as they may not necessarily tell you who actually owns the wallet, but you will be able to see the actual transaction on the blockchain. And what it does is it builds data on a structure of blocks, hence the name blockchain, and ultimately stores this data and keeps updating the information by adding new blocks that then replace the old blocks of information. Again, this is just really, if you think about it, it's kind of like a shared Google Doc or a shared Excel sheet that people keep changing and having transactions, but everyone's able to look at and see all the transactions and see what the balances are. So it really does provide a lot of transparency and a centralized database that can help with a lot of different types of transactions. So some of the common types of overall crypto assets we see are digital currency, right? That's sort of the low-hanging fruit, Bitcoin, Ethereum, almost everyone has heard of that at this point. But there's a lot of other adaptations of this technology we're seeing as well. So non-fungible tokens, which we'll talk about a little bit more in a minute, non-fungible animals, which we've actually seen as well, and stable coins, which are really meant to be more in line with how you think of the dollar. So stable coins are typically pegged to the dollar and are meant to function and stay at a dollar value, hence the name stablecoin. As we've seen in recent months, this doesn't necessarily always work out with the Terra Luna collapse. So it's important to understand the actual blockchain you're using and the actual technology behind it to some degree. But the idea of stablecoin, and there are many stablecoins that do function properly and are pegged to the US dollar. So it's just sort of a way to maintain that and function. So there really are a lot of different, even from a digital currency perspective, a lot of different ways to adapt this and use this technology. Next slide, please. Now, the most common one that we talk about, right? Cryptocurrency. Well, what actually is it? Essentially, these digital currencies are on the blockchain and they have transactions that are verified and records maintained by this decentralized blockchain, which uses cryptography to make sure it's secure, rather than by a centralized authority. So there's no government, there's no central bank, there's no one processing these transactions. It's essentially decentralized and autonomous and used to provide a store of value that you can then exchange. And again, these are just some of the larger cryptocurrencies, but there are many out there that their primary function is to be solely be a cryptocurrency and provide for an exchange of value. Bitcoin obviously being the largest and best example of that. Non-fungible tokens. So this has taken, this is kind of the next step from cryptocurrency, right? We started with Bitcoin, cryptocurrencies, we're exchanging value, and now blockchain technology kind of takes another step into non-fungible tokens. And essentially what these are cryptographic assets that are on the blockchain that have unique identification codes and metadata. And ultimately this distinguishes one from the next. So you can actually look on the blockchain and see that this person actually holds this digital asset. Now, it's being used for a lot of different things. It could represent real world objects like art, which is probably the best known use case for NFTs at this point, but also used for things like music, certainly in-game items in gaming, where I think this type of non-fungible token technology is probably going to see a big growth in terms of its usage and the way gaming adapts to this. So I think that's going to be one of the early uses of this technology that we're really going to see blossom, and videos as well can be contained in these. So ultimately, I think there are a lot of different ways that we're going to see this adapted that, again, we're just not even thinking about at this point. Now, NFTs are frequently bought and sold online using cryptocurrency. And ultimately, like I said, it is becoming one of the best ways to buy and sell digital artwork. So we're seeing that's probably where most of the financial activity has been to this point. But this, again, is being adapted in so many different ways, from being part of, like Brad mentioned before, a membership organization, right? Who are the members? Well, they're the people who hold these NFTs, and now we can verify that using this blockchain technology. So there are things like that. There are all different types of ways that this NFT technology and blockchain technology can be leveraged that I think we're going to see growing and expanding within the charitable sector.
And already have, right? So some of the trends that we're seeing, as Izzy's mentioning, there are creative uses for these technologies. One of those creative uses is a membership where you are the holder of a certain NFT that entitles you to some benefit in the future, whatever that benefit may be, whether it's access to a club, whether that's access to an event, whether that's one of many things. So that's one area that we're seeing. We're seeing this new age of donors where individuals want to transact, what they call keeping people on the chain, meaning that they want to pay for things with cryptocurrencies, but they don't want you to liquidate those cryptocurrencies. They want you to hold them and use them for certain continuing transactions. We've seen not-for-profit models kick up where the actual receipt of the contribution and the transfer of the grant going out, the actual donor wants you to not convert it to fiat currency. And when we say fiat, we just mean your tradable cash US dollar or other like currency. They want you to continue to utilize that cryptocurrency through the whole process. And there's a transparency to it, as he said, because you can read and see this blockchain. So we're seeing that as popping up, right? It's not mainstream. You don't hear about this every day. You don't hear about that many organizations doing it. In 5 years, will be the testament of time whether we do or don't. But we are having a lot of discussions, even at our micro level, me and Izzy's firm level. We're starting to have a lot of those discussions about people strategizing with how they can use digital assets in a creative way. It's definitely seen as trendy. Many of us kind of view it as a trend, but that trend is starting to prove the test of time. We're starting to see more organizations actually start to hold digital assets. For the most part, over the past year, I would say the majority of not-for-profits that we've worked with have gone through a payment processor to receive and liquidate the assets right away. We haven't seen a lot of individuals a lot of organizations, not-for-profits, open their own wallets and receive cryptocurrency. We've seen most take on the conservative strategy, which is this is a mechanism for us to receive a donation, but we're not going to assume any of the risk that quote unquote asset holds, and therefore we're going to liquidate it. So it definitely becomes, the biggest trend I see is this risk management discussion of, how are we going to view this world and how are we going to interact in this world? And the reality is the biggest, trend is just an uncertainty of, what does it mean to us? What does it mean to my not-for-profit to receive a cryptocurrency? And that's what me and Izzy are going to cover in the next couple slides is, what are some of the implications of receiving and holding these assets? And what do you need to know if you are going to go into it? There's really no answer whether it's right or wrong, but it's more of a risk question of, if you're going to receive an asset and it's worth X, are you willing to tolerate what's going to happen in 2 years with that asset, with the unpredictability of the pricing of these assets or quote unquote crypto assets? But we do see a significant opportunity, mostly on the fundraising side. Like I said, my grandparents' generation grew up handing cash to the church. Their kids' generation grew up writing checks and handing checks to people. My generation grew up using a credit card or debit card to make payments. The next generation of individuals in the world now grew up using cryptocurrency to pay for things. Not necessarily, buying a Slurpee from 7-Eleven like I used to, pay cash for, but starting to use that as a mechanism, right? A lot of the current philanthropists right now who are donating significant dollars to charity are wanting to donate those dollars in cryptocurrencies because of the apparent tax benefit that they received, especially last year when the prices of a lot of these, when you converted them to fiat, were significant. Bitcoin went from $0 basically less than 10 years ago, went all the way up to $60,000, dollar per Bitcoin. Now it's down to about 20,000. So you're seeing this extreme volatility. But that volatility is probably expected because I think a lot of people took advantage of donating those assets. So obviously with that change in hands, you tend to see changes in prices when there's a lot of activity like that. So certainly a lot of opportunity, but at the same token, there is risk, and me and Izzy are going to talk a little bit more about those risks. So with that, we'll take a pause, take a polling question to get your CP credit, and then we'll forge forward with some tax considerations.
All right, polling question number 2. Does your not-for-profit own any cryptocurrency or digital assets? All right, we're about halfway voted. Give it a couple more seconds. All right, get those last minute answers in, and I'm gonna close it out. All righty, we have 7% said yes and 93% said no.
All right. Well, power to the brave 7% out there who are currently in this world, and certainly many more of you, I guarantee, are going to get involved more. But certainly it's good pulse, right? I think we were using this question as a mechanism to pulse the audience and just get a sense of out of a small microcosm of a world, how many, people are directly involved, how many people have a wallet, and how many people are using crypto. So with that, I will forge ahead, and this is probably the fun part of the conversation, which is the tax issues surrounding crypto assets.
Absolutely. Thank you, Brad. And I think it'll be fun to revisit that same polling question in a couple years and see where it's at, because I think over the next 5 years, that's going to change a lot. So talking about these crypto assets from tax purposes, we talked a little bit about what is a crypto asset, what it is not. What it is not for tax purposes is currency. The tax treatment is as property, and on the next slide, I'll show you the IRS pronouncement that delineated that. But essentially, you have cryptocurrency that is not treated as cash. You have Bitcoin that is not treated as cash. What it is treated is as property, which is a capital asset. So if you hold it for less than 1 year and then you get rid of it, you have a short-term capital gain. If you hold it for more than 1 year, get rid of it, you have a long-term capital gain. So it leads to this really interesting interaction where in one case where you're a donor, you use your cash, you go buy things, right? You're spending your cash, you're acquiring goods and services of value, no impact. If you do the same thing with Bitcoin, there actually is a tax implication. You technically have a capital gain or loss based on whether you had a gain or loss on the actual value of the Bitcoin when you used it to purchase goods and services. So this has led to a little bit of a dilemma when actually adapting this and using this as currency because of this capital gain aspect, which kind of threw a wrench into things for a little bit. But we'll look at how that can be an advantage as well. Next slide. So this is essentially where we've gotten the current IRS tax guidance and how we know how to treat this. In 2014, the IRS issued notice 2014-21. Essentially, this is where they delineated that virtual currency is treated as property and provided some examples as to how to apply typical tax provisions to these virtual currencies. Again, very similar to other types of capital gain property that is owned. And then in October 2019, the IRS posted an FAQ updating some of this information from 2014-21, talking about some of the same principles, as well as some of the more complex issues that come up related to the treatment of airdrops or hard forks, which are all different types of issues that come up and benefits of the blockchain technology and different cryptocurrencies and are much more technical matters. But again, to some degree, this is essentially somewhat of the Wild West during the life of blockchain technology, and there isn't much regulation around this. I think to some degree, it's still trying to be understood in different ways. So I would expect that we're going to see a lot of regulation and legislation over the course of the next few years. And we will talk a little bit about the end about some of the proposed legislation that's out there. But I would just mention that I think this is actually a really good thing. I think for this industry to move forward and to grow and mature and be adopted into the mainstream, it's going to need that regulation. People are going to want to have that confidence in the currency that they can use it, that their assets are protected. Too often we hear these stories about crypto assets where they were on some exchange. I think the biggest one that happened recently was Voyager, which was a relatively large exchange, just went bankrupt, and now people can't get their assets out. And there's some confusion around to what degree those assets are actually protected. But again, it's not a bank; they're not FDIC insured. So I think that providing these regulations may have some growing pains in the short term, but ultimately it's going to be good, and what's going to be what allows the industry to really hit the mainstream and be universally adopted. So delving in a little bit to what the IRS has told us when it comes to both individuals and charitable organizations. For donors, these are really the main questions. And again, a lot of it relates very similarly to if you were donating a stock. For donors, do you recognize the gain or loss if you donate virtual currency to an organization, or is it treated like a stock where your capital gain or capital loss would not be recognized by you? Additionally, how do you actually calculate your deduction for this virtual currency that you may have donated? On the charitable organization side, what do I have to do when I'm receiving these types of donations? What are my donor acknowledgement requirements, as well as what are my IRS reporting obligations if I've received donations of cryptocurrency? So I would recommend, and I did post a link up there, taking a look at this. The IRS FAQ does have some good and detailed answers and examples around these. But again, the treatment in a nutshell is really the same as any type of property donation or capital asset. So I think, looking at the treatment for a donation of a security or a share of stock, I think is probably the best way to understand, both from a donor deduction perspective and from an organizational reporting perspective, what has to be done with these types of donations. But to go into that a little bit more, next slide, please. So for donors of virtual currencies, general rule, as with donations of cash or stocks, if you donate virtual currency to a charitable organization described in 170C, essentially a 501c3 organization, you're not going to recognize that income gain or loss on the donation. Now, there is a distinction in the amount of the charitable contribution deduction you will get, because a donation to a public charity will get you a donation for fair market value. If it's held for more than 1 year. Donations to private foundations, however, you would basically get a deduction for the lesser of basis or fair market value. So you do want to make sure that you plan around this to make sure that you're actually maximizing both the deduction as well as the capital gains avoidance that we'll talk about in a second. Next slide, please. So on the donor side, donors are required, as with any sort of donation, to obtain documentary evidence of their donation. For contributions in excess of $250, donors do need to receive, similar to a cash donation, similar to a stock donation, they need to receive an acknowledgement letter with the same types of detail that's provided with all other types of charitable donations. As again, with regular charitable donations, if it's over $500, the donors need to file Form 8283. Now, if it's in excess of $5,000, donors will also need to get a qualified appraisal conducted by a qualified appraiser who's licensed to do these. But you really want to remember that cryptocurrency is not currency. Again, it's not publicly traded stock, and you do have substantiation rules. So unlike with a publicly traded share of stock, where you just have a market that's trading these and you have values you can easily obtain, since a cryptocurrency is not a type of asset that, as such as a publicly traded stock, you cannot rely, even though there is a market, even though you can go on Coinbase, you can go on a lot of different places and look at the price of Bitcoin, but since it is not defined as a currency or a publicly traded stock, you still have these substantiation requirements. And taking it a step further, which there isn't much guidance around yet, but if you look at NFTs, which are something that in general is supposed to be unique in of itself, and when you're doing an appraisal, you're typically looking at things like comparability, comparable sales. It may be some level of complication to actually be able to say, well, this is comparable to that, if everything is by definition individualized. So that's, I'm sure, something that they'll have to work out in the regulations, but it just goes to speak to the fact that this is such a unique concept and a new concept that we're going to have to see adapted over time through these different regulations. Next slide, please.
Yeah, and I think that valuation becomes super important. And some of the questions that we're kind of getting up front right now is on that valuation concept. So, when you're thinking about making these donations or receiving these donations, that valuation question, and I'm going to talk about the GAAP side of this in a little bit, but how do you substantiate recording the fair market value of a donation of something? How do you get that value to record in your financial statement, even if you're thinking about GAAP? There certainly is. It's not like property where you can. It's not the same as like a property out there. So it certainly is a little bit more challenging, especially when we talk about NFTs. But I'll leave it there.
So I also wanted to talk about a couple of the issues that come up around this that we don't necessarily have much detail or answer for, but definitely things that need to be considered. Starting with prudent investment, all charities are subject to MIFA, And for foundations as well, they have jeopardizing investment rules under IRC 4944. Basically, all these rules require diversification, limited volatility. And so when you look at cryptocurrency and other types of digital assets, and just to kind of branch this out a little bit more, even if you look at retirement plans and the types of assets they hold, you've seen in the past couple of months, Fidelity had announced that they were going to start offering Bitcoin type investments for their 401k plans. And benefit plans similar to charitable organizations with MIFA and these types of regulations do have very strict requirements under ERISA regarding prudent investment. So the question then becomes, with something such as cryptocurrency or NFTs that are so volatile, could there be an issue under this? So I don't know that we necessarily have the answer to that at this point. But it's just something that organizations really want to consider, because beyond, do we understand this? Is this going to be extra work? Those types of things. Does the IRS allow us to hold this? You do really want to also consider it from a prudent investment standpoint to make sure that as a director or as an officer of the organization, you're meeting your fiduciary responsibility to only invest in prudent types of assets and limit volatility. So definitely something that all officers of the organization want to keep in mind.
Yeah, and on the financial accounting side too, for endowment accounting, as Izzy's talking about a little bit here, I haven't directly seen, but I'm sure we will soon. I haven't directly seen too many endowment portfolios out there that are holding these digital assets. I'm waiting to see some of the financial statements come out from last year that get publicly posted to see who actually, if they disclose anything about holding digital assets, because we'll talk about in the FASB part of this, there probably are going to be significant risk disclosures that organizations are going to put in their financial statement related to these, similar to how you have the FDIC risk footnote in your financial. If you're holding these assets in their material, there's going to be other risk disclosures that I imagine organizations are going to start putting in their financials. But I digress.
So UBIT, right? Yeah, right, UBIT, unrelated business income tax. Essentially, cryptocurrency is a capital asset. So sales of cryptocurrency, which we said are capital gains, are considered passive. Typically, passive types of income would, by definition, not be unrelated business income. Therefore, if you do have a gain on the sale of cryptocurrency, you would not have to consider this as unrelated business income. Now, that is simply on the capital gain from the cryptocurrency. If there is any sort of crypto mining activity, or if you're running servers that validate transactions on the blockchain, which essentially is how you would mine proof of stake transactions, or sorry, proof of work transactions. Ultimately, you run all these transactions using your computing power, and you'll be therefore rewarded with pieces of Bitcoin from the blockchain. Really, there's no actual guidance on this that specifically address this, but presumably if you're doing this, there are a lot of companies that do this. It's a trader business, and if you're actively doing this, that would likely be considered unrelated business income. The other thing I would point out is that if you do use debt to acquire these Bitcoin or crypto assets, that could be unrelated business income as well, because the income generated by them would potentially be subject to the debt financing rules. So unless you've used leverage to acquire these crypto assets, or you are actively running crypto mining or some other type of active business related to this, you should not have an unrelated business income tax issue for the most part with cryptocurrencies and other blockchain technologies. Now, I did want to point out, although cryptocurrency is not, like we said, these are not securities, they're not subject to the SEC. Nonprofits are subject to securities laws. Now, there are some instances where cryptocurrencies seem like they might be securities. Again, this is not something that there are regulations around or is codified. But if you look at some of these things, they do have governance rights, they do have voting rights that really do ultimately control what the organization, or I'll say the decentralized organization, does over the course of the future. Now, the SEC has, and I think the most famous one is against Ripple, has had some litigation to try and work out whether these are actually disguised securities. That remains to be seen, because I think to some extent That does exist within the blockchain technology uses. You look at cryptocurrency, it can really be a means for voting, a means for ownership in many instances, but in some other instances, it's really only used as currency. So I think this is something that's going to have to be worked out over time, but something for organizations to remain aware of if they do want to hold any of these cryptocurrencies that have more that use cases such as voting rights or other types of things rather than just as cryptocurrency like Bitcoin. And the only other point I'll make is that when you are developing your policies for accepting these types of things, you may want to also consult with the securities attorney as well if you are interested in holding these types of assets, because again, that can get really dicey and you really don't know how the litigation is going to come out and ultimately what the effect of that will be. Now, we talked a little bit about the donor perspective. From the nonprofit organization perspective, if you receive virtual currency, essentially this is treated as a non-cash contribution, the same way with any other non-cash contribution. The donor's basis would flow over. You would report these on your Form 990, on Schedule B for the actual contribution, Schedule M to report non-cash contributions, and ultimately Form 8282 if the charity disposes of this property within 3 years after the date they originally received it, they would need to file this as with other property and other non-cash properties, since again, this is not considered currency. Now, charitable organizations can definitely, like we mentioned before, provide donors and should provide donors if the value is over $250 with an acknowledgement letter. Charitable organizations also typically sign the Form 8283 for the non-cash charitable contributions, but bear in mind that this does not mean that the organization agrees with the appraised value or anything to do with the value of the contributed property. So you're not actually attesting to that. You're just acknowledging that you received the property that's described in this Form 8283 that they're filing. So it's certainly, not much risk for the organization to sign off on that and provide that. You're really just saying they gave us this property. And again, you're not actually attesting to the value of it in any way. Now, finally, or almost finally, what I want to talk about from a tax perspective is the assignment of income doctrine. Now, like Brad mentioned earlier, a lot of what we've seen in terms of not-for-profit organizations and how they've been sort of dipping their toe in the pool of crypto has been through third-party processors who essentially will accept the crypto, hold the crypto, liquidate the crypto, and then just give cash over to the actual organization. So the organization doesn't actually have to have any custody of the crypto assets. However, it's really critical to make sure that the donation is properly structured in that it's actually going to the charity and that you don't end up with an assignment of income in which essentially it'll be a situation where you'll donate it to the charity, but really what's happening in the transaction is you're really giving it to a third-party processor who's essentially buying it from you, so to speak. They're liquidating it and then they're giving the cash to the charity. So ultimately, as you can see from this example, what happens in that case is the donor stuck with a capital gain, has a $1 million deduction, but ultimately that's going to get limited because of their regular AGI limitation for their deduction. And the charity does get the $1 million in cash. So I think the key with this is for charitable organizations that are going to do this to make sure that in the flow of funds, whether they use a third-party processor, whether they use someone else to process these transactions, if it's not their own wallet, they need to make sure that it is structured so that the actual donation is coming to them and that they are actually taking ownership of this prior to the third-party processor, so that there is no assignment of income issue. And then finally, I just did want to say something regarding privacy and reputation. For not-for-profit organizations, obviously this is something that is really, really sensitive. Organizations in the not-for-profit world really do live and die by their reputation. So there could potentially be a lot of reputational risk around this. So it's something you want to keep in mind. Blockchains, like we've been talking about, very transparent, which is great. But at the same time, that means that people can really see where the transactions are and what transactions are done by each wallet. Now, wallets may not be identifiable by an individual, but you can see all the transactions of every wallet. So potentially, if you are getting contributions from donors, you really want to know who they are. You could get a contribution from an anonymous wallet who could be giving to, terrorist causes. They could be giving to a lot of bad things. So I think the real takeaway from that is to make sure you understand, it's great to receive contributions. It's great to receive contributions of cryptocurrency, but it's really important to know who these are coming from and make sure that there's no reputational risk out there. Because again, part of the benefit of the blockchain is its transparency, but ultimately that's something you need to be wary of as well. And with that, we'll go to polling question number 3.
All right, polling question number 3. When you think of digital assets, what is the first thing that comes to mind for you? Bitcoin, blockchain, NFTs, fraud, and corruption.
Fraud and corruption.
We got about half the people voted, so I'll give it about 10, 15 more seconds. All right, get those last minute answers in. All right, we have 76% said Bitcoin, 7% said blockchain, 11% said NFTs, and 6% said fraud and corruption.
Probably what we would have expected. All right, let's go to the fun part of this presentation here. Not that Izzy's part wasn't fun, but accounting and auditing, which is being completely sarcastic. The accounting and auditing side of this is probably the least fun part of all of this, and we're going to find out why. So a lot of this, I will tell you, is based on interpretation. This is part of our interpretation. I'm not speaking on behalf of the FASB or anyone out there. This is more kind of a generalized interpretation publicly right now. Just so everybody knows, and based on my current understanding, there's not a FASB pronouncement around accounting for digital assets. Therefore, we are left to interpret the existing accounting pronouncements that exist and then operate within that framework of existing accounting pronouncements. And so what that means is that we have to analyze these digital assets on an asset by asset basis. So what I'm about to tell you is a generalization, in the sense that accounting for Bitcoin may not be the accounting for a stable coin. It may not be the accounting for an NFT, or it might be. There might be equivalency among the many different types of assets we're going to talk about. So you need to take that as a vacuum in receiving these assets and recording them. You have to understand what each asset is. And ultimately, what I'm going to tell you is that you're going to have to track each of these assets individually. And that's going to be one of the onerous parts that many folks are going to be turned away from holding these assets because of that, how you have to track them. So anyway, let's think about this. And like I said in the beginning, I gave you a little bit of a clue into this, but the way that the couple guides that are out there, the way that I've interpreted this based on my kind of research and knowledge of Bitcoin and blockchain and everything else, is that you have to understand what digital assets are not. And so in doing so, we're trying to isolate what part of FASB or what part of accounting does it fall under by analyzing where it doesn't go. So in very, very general terms, digital assets, like if I use Bitcoin as the example, it's not cash because it's not legal tender, it's not issued by a government, and it's not backed by a sovereign authority. So when you think of the US dollar, obviously the US government backs and supports that US dollar. It's not really known how it'll be converted to cash. Similar to like gold, if you think about gold, gold isn't really considered a currency per se, but in certain cases it is pegged against currency. In certain cases, like as you mentioned, stable coins are pegged, so that peg holds a value. That peg could be treated as cash. So there are circumstances where it could be viewed as cash, but for the most part, like a Bitcoin, if you own a Bitcoin, is not cash. It's not a financial instrument. There's no real ownership in another entity. There's no real contract. And also, it's not a security by virtue of it's not regulated by the securities law. It's not considered a security by GAAP definition, and therefore it doesn't really fall under that guidance of investment. It's not inventory, as it's not a tangible asset. It's not something that you can hold, or you could sell it, but it's not something you can hold. And so where does that leave you? It leaves you with a small subset of GAAP about intangible assets, which are assets that lack physical substance. But they are assets nonetheless. There is a tradable value to it. There is a use for it. And so in many cases, the current GAAP understanding of this is that it's an intangible asset. And in most cases, it's an intangible asset without a definitive life. There's no assigned life to these assets. They can last forever, theoretically, based on current understanding. And therefore, you don't amortize it like you would amortize a customer list, which has a finite life, or at least we traditionally consider it having a finite life. So, what are some of the pros and cons? Well, as an indefinite life intangible asset, as you know, or as you may not know, you have to assess it for impairment. So you don't amortize it, you assess it for impairment. And, one of the current understandings of it right now, or one of the current interpretations of it, is that the asset theoretically is impaired when the value decreases. So if you think about that, you may have an asset, many of you that purchased Bitcoin at a higher value, right now you may have an impairment situation where that Bitcoin is now below that cost basis that you acquired, or if you're a not-for-profit and it was donated to you, that original cost basis that was assigned to you. And therefore, you may have some unfortunate accounting consequences, i.e. an impairment loss to reflect in your financial statement. There is a current understanding as well that you're going to be accounting for these assets on a unitary basis, which means if any of you have ever done endowment accounting, you've done it on a unitary basis where you're assigning units to a particular asset. Well, every time you buy and sell a Bitcoin, it's a different unit that you're buying and selling. It's a different cost basis that you're buying and selling, unless you're aggregating them on a particular day. For the most part, if you buy it on January 1st, you buy it on June 5th, those are different cost bases that when you buy them, and therefore when you analyze for impairment, you're going to that individual purchase level, not necessarily the global portfolio level, which, that's one of the issues that I've heard publicly is creating some angst among holding these assets. There may be some valuation issues if not readily traded, or how do you do the impairment assessment? Some of the more common mainstream Bitcoins, you can publicly look up that price. Not Bitcoin, say some of these NFTs, how do you evaluate the current price? There is a market for some NFTs. There's trading auction houses like OpenSea and other places. Izzy has his OpenSea non-fungible token T-shirt on, which we got at the NFT conference. But like I'm saying, impairments, you never write them up. You only write impairment down. So that's one of the negative consequences based on the current understanding, is that you have an intangible asset, which ultimately you write down that asset. There are certain cases where it could be costly to track and report this. There are companies out there that do track and report these types of assets. There are companies that assist with that tracking and reporting. And in many cases, organizations that consummate a lot of transactions are definitely going to need to use some type of tracking mechanism outside of Excel, because it may get relatively complicated. And lastly, the other kind of negative side of this is kind of the fraud and volatility discussion. There may be footnotes you add to your financial statement to talk about the volatility risk related to these assets. The same way you have a cash footnote that talks about FDIC insurance, you're going to have a footnote that describes that we have a portfolio of crypto asset, digital assets that carry a certain level of risk to the financial statement because of how volatile the value of those could be, and the potential negative future effect of having those assets within the portfolio. There's also a fraud risk that many are talking about right now, and that is from a money laundering perspective, and from knowing your donor. The KYC laws of know your customer don't necessarily apply, but I think a lot of legally, I think there's going to be a lot of attachment of blame placed, even if there isn't necessarily a direct law or regulation affecting you. Any asset you receive as a not-for-profit the second you receive it, you've accepted it or you've received it, unless there's some mechanism where you receive something by error or you didn't know and you find a way to remedy that scenario. As Izzy said, there could be some massive PR issues related to accepting and holding some of these assets, not knowing where they're from. If you Google it, there's some public backlash that's created due to the environmental effects of mining cryptocurrency. And so when organizations that may be in the environmental space have explored accepting these assets, they receive a lot of pushback from the public. So not only is there a volatility risk, but there's also fraud risk, and then lastly, there's public relations risk. So the term risk is over and over. I'm conservative as an accountant, so you probably hear me talking very negatively about this. I'm not trying to be negative. I think a lot of this is just laying out the facts of what the current interpretations are. I don't think there's a positive or negative per se to holding or owning these as an organization. I do think there's a positive or negative if you go into it without strategy. I think if you go into owning these assets because one donor decided to give you Bitcoin and you don't understand the consequences, you may be making a mistake, or you may be rushing to judgment to something when all of a sudden your board's like, wait a minute, why did we accepted Bitcoin? Like, we're an environmental organization, like we can't accept Bitcoin. And so the bigger picture is the strategy you employ here, and understanding the fact that there are certain interpretations on how to account for this, and knowing those interpretations before accepting it, as there could be a negative ramification. And for those wondering, in the not-for-profit world, financial reporting, impairments are shown above the line, not below the line. So impairment is one of those items that you can't put into an operating measure. And so also an area that may create a little bit of complication, where you could show an impairment loss, which could negatively affect a ratio or another calculation, where sometimes investment income is excluded. You know, can you really call this investment income because it's an impairment? So just think about these things. You know, this is based on current interpretation. My gut assumption is that this is going to change and that there's going to be pronouncements and further guidance that's issued. But based on that current guidance, that's kind of where we sit. So I'll go to polling question number 4 and then get everyone their CP credit, and then Izzy's going to share a few thoughts, and we'll get out of here on time.
All right, polling question number 4. After this presentation, are you more or less likely to engage in digital assets? All right, we're about halfway voted. Give it about 10 more seconds.
Yeah, let's get all that in. So a significant number of people on here. So definitely get that credit in, just so we can give your CP and also take away the slides. There's a couple of takeaways that Izzy's going to go over now.
All right, closing it out. And we have, looks like it's about halfway. 49% said more likely and 51% said less likely.
All right. So I don't know if we swayed anybody's judgment, but that's okay. So take it away.
Yeah, absolutely. So just a little bit about what we see on the horizon. There is an Infrastructure Investment and Jobs Act that was enacted in 2021. Essentially, this expanded some of the current broker reporting rules and expanded as well some of the regulatory authority around transfers of more than $10,000 in cash. There was also a presidential executive order issued in March 2022, essentially saying that there should be a response to digital assets, as well as looking into the anti-money laundering efforts to counter financing of terrorism activities, which unfortunately is some of what cryptocurrencies have been used for in the past. But again, I think we've talked a lot about how they are going to be adapted in the future. I would just say again that I would expect to see more regulation around this, more regulation bringing cryptocurrencies such as Bitcoin in line with actual currency. So I know that there was a proposal in, I believe, I forget which it was, the House or the Senate, where they were essentially saying for transactions under $200, there would be no capital gain impact. I think this type of regulation will be very good for the industry. I think, again, will allow it to move into the mainstream. And I think if we revisit this conversation in a couple of years, we're probably going to see a lot more organizations who are already utilizing these types of technologies significantly. So we just kind of wanted to circle back and talk about some of the takeaways, because as we've said, this is very early stages of this technology, and we still don't necessarily know how this is going to be adapted. But I think the best thing organizations and even individuals can do is try and get ahead of this. And step one really being go back, look at your organization's gift acceptance policy and strategy, look into that, revise that, make sure it addresses crypto. The last thing you want to do is have to be reactive with this because a donor just showed up and wants to give you $100 million Bitcoin donation, and now you have to figure out, can we do this? How do we do this? Is this allowable? If you've taken these steps before, updated your policy, it just makes life a lot easier when it comes to that. So I think that is really the #1 thing that we stress, is that you really just need to try and get ahead of this, have a policy in place, whether you want to accept it, whether you don't want to accept it. I think that's really step one. It is the flip side of that being, really think about this. This is a strategy. This is an opportunity for fundraising that we really haven't seen before. Probably what I would most correlate it to is when the donate now buttons showed up on the websites. It's really just a jump in technology that allows really, really interesting fundraising opportunities. And you see some charitable organizations, we talked before about non-fungible animals and all these things. There are some charitable organizations out there that are really trying to get innovative and really trying to use this as an opportunity. When it comes to receiving crypto, the big consideration, do you want to hold it? We talked a lot about the effects of that. So, whether you want to hold it directly or just receive it through a third party and just receive the cash from those donations are a really big consideration. And that's one of the things that you really need to think about up front. Regarding the organization's mission-related considerations, Brad touched on this. You really want to make sure that if you are using a cryptocurrency or digital asset, that it does represent the values of your organization, whether it be due to ecological concerns, whether it be due to other types of relationships. You want to understand what the asset is and what else it's related to, and make sure that it does line up with your organization's objectives. We talked a little bit about who is the donor. Again, privacy and transparency are important, but at the same time, you need to know, we talked about KYC, where is this money coming from? Who is this donor? And is this someone that I'm comfortable accepting these funds from? Similar to with environmental organizations accepting a cryptocurrency that's not environmentally friendly. You really don't want that reputational risk. This is the same thing. You don't want that reputational risk. You want to understand who is the donor that is giving you money. And ultimately, you want to be prepared. What are you going to do if someone comes and says, hey, I want to donate this crypto asset, right? Organizations can always use more funding and always want to be able to accept these. So it's important to have a strategy that you've discussed and you're comfortable with and can ultimately benefit the organization. And so I think these are the major takeaways of where we're at right now and how organizations can adapt and utilize blockchain technologies.
Awesome. Thanks, Izzy. Thank you, everybody. Appreciate your time. We went a couple minutes over, but the slides are a takeaway. If you want to check out our Civic Warriors podcast on the major podcast platforms, we have a few episodes which go into a little more detail on different topics related to digital assets and receiving donations, and a few articles out there. But I appreciate your time. Appreciate you spending some couple minutes here afternoon with us. And if you have any questions, you know where to find us. Have a good day, everybody. See you.
Thank you to everybody for joining us today. We will be sending a follow-up email with the PowerPoint presentation and webinar recording. Please take a moment to fill out the post-webinar survey. Thanks again and have a great day.